Hey guys, this is the Investment Venturer, and welcome to the Investor Next Door podcast. Today we'll be discussing why Bitcoin hit new all-time highs last week. I should let you guys know that anything said on this podcast should be used for information and entertainment purposes only. This is not investment advice, and I do not recommend diving into any project or trying any strategy without doing your own research first. Bitcoin surged to new all-time highs last week, reaching peaks around $118,000 to $119,000, driven by a potent mix of institutional moves, macro trends, and political momentum. Before we dive into why Bitcoin hit new all-time highs, let's first discuss why Bitcoin is so volatile. Bitcoin is volatile for several key reasons, ranging from its market structure and liquidity profile to speculative demand and regulatory uncertainty. Here's a breakdown. Limited supply plus speculative demand. Fixed supply of 21 million BTC. Scarcity drives demand swings. Prices highly influenced by speculation rather than consistent fundamentals. Traders react quickly to news, hype, or fear, causing sharp ups and downs. Low liquidity compared to traditional assets. Bitcoin trades 24/7 globally, but its order books are thinner than stocks or fiat currencies. Even relatively small buy-sell orders can cause large price movements, especially on weekends or during low-volume hours. Market sentiment and herd behavior. News rumors, tweets, for example Elon Musk, and economic events can cause rapid sentiment shifts. Emotional and momentum-driven trading leads to herding, triggering boom and bust cycles. Lack of intrinsic value anchors. Unlike stocks, which are tied to earnings, or bonds tied to yields, Bitcoin lacks cash flows or hard valuation models. This makes it harder to value, leading to wild price discovery based on narratives. Regulatory uncertainty. Global governments differ on how they treat crypto, asset, currency, security. Any change in policy, like ETF approvals or bans, can cause extreme volatility. Leverage and derivatives. Crypto markets are heavily influenced by leverage trading, futures, perpetuals, options. Liquidations of long or short positions cause violent price swings, called short squeezes or long squeezes. Still a young asset class. Bitcoin is only approximately 16 years old, and its investor base is still evolving. As adoption grows, volatility may decrease, but for now it's a risk-on high beta asset. Now that we understand the reasoning behind the volatility of Bitcoin, let's discuss why it hit new all-time highs last week. Record-breaking ETF inflows. On July 10th alone, spot Bitcoin ETFs raked in approximately $1.17 to $1.2 billion, a historic single-day high. These inflows reduced available supply and fueled a rally, triggering a cascade of short covering. Short squeeze amplification. As prices climbed, over $570 million in short positions were liquidated, adding momentum to the upside. Pro-crypto regulatory climate. U.S. President Trump's administration has taken several crypto-friendly stances, signed an executive order in March 2025, creating a strategic Bitcoin reserve. The Senate passed the Genius Act, with the House expected to review it during a landmark crypto week starting July 14th. These developments boosted investor sentiment, injecting long-term confidence. Macro tailwinds, Fed and dollar. Expectations for upcoming interest rate cuts, along with a weaker U.S. dollar, created a favorable backdrop for risk assets like Bitcoin. Institutional and corporate adoption. Companies continue to add Bitcoin to their treasury reserves, while asset managers and institutions widen their exposure. Bitcoin is increasingly considered a reserve asset, supported by political backing and institutional sentiment. This rally feels different from past cycles, less retail frenzy, more institutional conviction, and strategic momentum from both policy and regulation. The first point was record-breaking ETF inflow. Let's dive a bit deeper into that. Massive ETF inflows fueled the spike. 2 consecutive days with over $1 billion in inflows marked a historic milestone, the first time U.S. spot Bitcoin ETFs saw that level 2 days in a row. Thursday, July 10th, approximately $1.17 billion. Friday, July 11th, approximately $1.03 billion. That week totaled around $2.72 billion in net ETF inflows. Why it matters. Demand far exceeded mining supply. On Thursday, inflows were 22 times the number of freshly mined BTC, approximately 10,000 versus 450. Institutional liquidity surge. These flows reflect strong institutional interest, not just retail buzz. Price impact. Such large capital inflows tighten available supply, fueling the short squeeze and propelling Bitcoin to record highs. $118,000 to $119,000. Last week's record ETF inflows marked a new level of institutional buy-side pressure, accelerating Bitcoin's push to fresh all-time highs. Over $2.7 billion entered in just 5 days, an influx unprecedented outside the initial launch phase of these ETFs. That's all for today, folks. Thank you for listening to my podcast. Be sure to subscribe to the Investor Next Door podcast on your favorite podcast listener. If you're watching on YouTube, be sure to like and subscribe for future episodes. Follow me on social media to stay updated. Twitter X @InvestNDPod. Instagram @InvestNDPod. Then share this episode with your friends if you've learned something valuable from this podcast, and I'll see you guys next time.